In this video, we're going to introduce the idea of options. We'll cover a brief history and talk a little bit about why people use options. Option-like instruments have been around for a long time. The first instance of an option-like instrument that we have record of comes from ancient Greece. According to the story, Thales, a philosopher who lived around 600 BC in Miletus, was out to prove a point. Someone had challenged him and told him that philosophers weren't good for anything besides talking. Thales believed in the importance of philosophy, but also knew that in order to be taken seriously, he needed to earn respect. Thales recognized that there was likely to be a bumper olive crop one season, and so prior to the harvest, he contracted with all of the olive presses in the area to have control of their presses during the harvest. When it came time to press the olives, Thales had a monopoly, and so made a lot of money. This is very similar to what modern option contracts are. Options were around in the 1600s during the tulip crisis. And there was a market for calls and puts in England around the same time. Stock options have been traded in the United States since the 1800s. Back then, they were all done on an individually negotiated basis. Traders would advertise for people to enter into contracts with them, and they would create options that way. In 1973, two things happened that changed option trading. First was the opening of the Chicago Board Option Exchange, or CBOE. Second was the development of the Black-Scholes option pricing model. The opening of the CBOE allowed for standardization of options and provided a structured marketplace for them to be traded. The Black-Scholes option pricing model was the first widely accepted model for valuing options. There are many flaws with the Black-Scholes model, and many models have been created to improve option pricing since. But the key principles behind the Black-Scholes model are still the key principles behind most option pricing models today. The math behind option pricing is based on partial differential equations. It's not exactly basic algebra. So for a long time, option pricing was largely a series of best guesses based on pricing models driven by market supply and demand. The advent of computerized trading and the ability to do the math faster has led directly to a huge increase in option trading that does not appear to be slowing down anytime soon. And in fact, in 2020, for the first time ever, option trading volume exceeded listed stock trading volume. What is it that makes options so attractive to investors? In a word, leverage. Leverage allows someone to invest with lower capital and thus risk less money. Leverage provides for potentially greater percentage gains than investing directly in a stock. That leverage can work both ways, however, and an option can lose money faster than a stock as well. The leverage provided by options also makes them extremely useful as hedging instruments. Well, now that we've talked a little bit about the history of options, watch our videos on option basics to get started using them in your portfolio.